US-China truce shows signs of unraveling. Nvidia silences its doubters once again. Indian automakers suffer a domestic hangover, and why Netflix continues to be the king of streaming. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode 130 of the Stock Doctor podcast. Now, what a great month May was for Wall Street. It posted its best month since November 2023. And while it did that, the final trading session, however, ended in a whimper as President Trump accused China of violating a tariff agreement. However, luckily, this did not ruin the overall week as the king of AI, Godfather Jensen's company, Nvidia, and a court ruling questioning the legality of the reciprocal tariffs provided enough fuel for Wall Street to help the markets, help all three indices finish in the green. Oh, and a cooling inflation number. Long lost, it's somewhere in the back burner nowadays in investors' minds. Cooling inflation number based on Fed's preferred inflation gauge also helped the markets. Once the dust settled, sentiment quickly went from negative 2 weeks ago to positive. The pendulum swung to the positive side last week, with all three indices ending the week firmly in the green. The Dow added 1.6%, S&P 500 climbed 1.9%, the tech-heavy Nasdaq, thanks very much to Nvidia, climbed 2%. The volatility, and a further sign that volatility is the name of the game. The VIX index, after jumping 30% 2 weeks ago, came tumbling down, plunged nearly 17% last week. What a whipsaw indeed. I mean, I did tell you, ever since President Trump took over, as far as the stock markets are concerned, the name of the game is volatility. It's no longer going to be a straight line. Expect the unexpected, a lot of uncertainties. And that's been proven the case. 2 weeks ago, in last episode 129, I did talk about VIX jumping 30% for the week. This week, it's plunging 17%. So here we go, roller coaster ride. I don't particularly like roller coasters, and when it comes to money, I even like them less. So I even like them far less. But what to do? Such is the world we live in. So without further ado, let me welcome you to Doctor's Weekly Snapshot and discuss the week gone by as usual in the US markets. And I'm going to start off by saying, if you've followed the show over the years, it's been, guys, we're nearly reaching 4 years. I mean, it's been, this September. So essentially, we finished nearly 3.75 years, 3.75 years. If you follow the show over these years, when Nvidia reports its earnings, and this company has been covered multiple times over the show, whenever I talk about Nvidia and its earnings, pretty much everything else takes a back seat, right? And the entire market action, if you've noticed, even without following the show, the entire market action usually in the past has been centered around the impact or the fallout or the positive impact, however you want to call it, around Nvidia's earnings, right? Alas, unfortunately, we don't live in Jensen's world anymore. We live in the world of Trump mania. As such, once again, the overall market action was dominated by President Trump and his administration's moves, specifically surrounding tariffs. However, there is a major difference. The major difference between the week gone by, the previous weeks, is that related to tariffs specifically. For the first time ever in a long time, it was the Trump administration that was on the back foot. When have you ever heard me say President Trump, tariffs, President Trump is on the back foot, or President Trump's administration is on the back foot? It's been a while. So I think it's the first time that's happened. And this is because on Wednesday last week, the Court of International Trade ruled that President Trump's tariffs enacted under the International Emergency Economic Powers Act, IEEPA, however you want to call it, exceeded presidential authority and were therefore invalid. Businesses and states that challenged the tariffs argued that the president lacked the authority to impose such sweeping levies, and the court's decision supports their position. While markets cheered to the news, it still doesn't mean that the game is over. Far from it, actually, for the administration. I mean, it's a setback, but by no means, you can't call the tariff chapter has come to a close or whatever. No, it's just taken a pause. And as further evidence of this, the Trump administration responded swiftly, with Justice Department lawyers requesting a stay on the ruling and indicating that they may escalate the issue to the Supreme Court if necessary. Now, the U.S. Court of Appeals for the Federal Circuit the appeals process fails, the administration can take it all the way to the Supreme Court. Now, at the same time, President Trump's administration is not, not waiting for it to go to Supreme Court or whatever. They've already gone into action. They've already gone into damage limitation, damage control. They've already gone into looking at Plan B, C, D, E, F, G, and so on. So President Trump is already preparing a two-pronged backup plan. One that allows tariffs of up to 15% for 150 days to address significant trade imbalances, which is legally valid. Another that would involve imposing targeted tariffs on specific countries or industries, once again, valid and definitely more appealable, definitely can withstand any lawsuit against it. So these two, the 15% tariffs, 150 days, and one that involves imposing targeted tariffs, they're definitely legally valid. Challenging that could be a whole, it could be a whole lot more difficult than what is happening today. So it's not like the court ruling effectively ends the tariff battles. It's a setback. That's all as far as President Trump's administration is concerned. And as investors like you and I, we also need to factor that in. As things stand, there's absolutely no change in status quo. Having said that, the fact that the president's team are exploring a legal option that imposes tariffs of up to 15% does suggest that the end goal could very well be a 10% or a 15% baseline tariffs across all nations. I mean, if you look at the UK deal, that's what happened, right? The baseline tariff was at 10%, as opposed to these ridiculous numbers that were imposed as part of reciprocal tariffs. I still am yet to figure out what exactly this methodology was when you hit 26% on India, 46 on Vietnam, another 64 on China, and all those random numbers. I mean, the methodology, how the rationale. Forget the legality, the rational, logic sense, it didn't make much sense to me. So, but a 10% or 15% baseline, given the fact that they are exploring the possibility that, we could impose a 15% baseline tariff, a 10% tariff might be the end goal. Remember, at the end of the day, this is a negotiation ploy. Yeah, this is not, it is not about imposing this forever, because the US stands to lose more if it is permanent, if these tariffs are permanent. It's a negotiation ploy, gets the countries to the table, and as such, probably a 10%, 15% baseline tariff for all nations. If this turns out to be the end goal, it could very well be the end. And if this turns out to be end goal, don't be surprised, is all I'm saying, because there are, even legal options suggest a 15%, 10%, whether it's for 150 days forever, that remains to be seen. Now, at the same time, another issue that investors need to factor in is that the 90-day pause the US and China had agreed upon may be unraveling before our very own eyes. And this is not good, my friends. This is not good, ladies and gentlemen. This is absolutely not good one bit. The courts can do whatever they want about the reciprocal tariff, but this unraveling, should it unravel the US-China trade war pause, yeah, that's not good. And that is because the central condition upon which the truce was reached, which was that China would speed up approvals for rare earth mineral export licenses, which are essential for manufacturing cars, semiconductors, and other advanced products, is not going according to plan. According to US officials, since the Geneva Agreement, which led to the trade truce, China has been slow-walking the approval process for rare earth exports, prompting US accusations that Beijing is reneging on its commitments. In fact, President Trump on Friday publicly criticized China for not fulfilling the deal, with the president stating on social media that China had totally violated the agreement. US Trade Representative Jamieson Greer specifically cited rare earth minerals as a sticking point, and US companies, especially automakers, warned that continued delays could force factory shutdowns similar to pandemic-era stoppage. And you will see it later, this is the same problem that's plaguing the Indian automakers as well, but more on that later. Now, official Chinese statements have insisted that Beijing is acting responsibly and honoring the Geneva Consensus, pushing back against the US claims of non-compliance. However, according to reports, Chinese officials, led by Vice Premier He Lifeng, reportedly became less willing to comply with the rare earth pledge after the US Commerce Department issued a warning on May 12th against the use of Huawei's Ascend AI chips globally, which Beijing interpreted as renewed American aggression. The reports also state that China views its export licensing system implemented in April as a strategic tool and leverage in trade negotiations. I mean, this cannot be surprising, right? As investors like you and I, we cannot be surprised. Obviously, if there's one leverage, it's the rare earth mineral. They pretty much own the market. I think it's about 90%, 85% of the refining. It's not even the rare earth. You can find rare earth, but to refine it, you got to go to China. And that's what the US happens. It's not like the other countries don't have these rare earth, you can't explore and find rare earth minerals. Only problem is who does the refining? China. They pretty much own the market. And if I'm pushed up against the wall and that's the only superpower I have, and it's a hell of a weapon, in Indian terms, probably that's their Brahmastra, I would use it, right? So it can't be surprising. So I mean, I'm not surprised that they're slow walking, reneging, however you want to call it. This has happened before in the past. So not surprising one bit. I mean, to make matters also just to let you know, in addition to all of this, while all of this was happening, President Trump quietly came out and announced that the tariffs on aluminum and steel, which were 25%, have been ratcheted up to 50%. So just factor that in as well. Okay, steel companies had a field day on Friday. I think Cleveland Cliffs and the likes of other steel, Nucor, all of those guys had a field day when the announcement came that 25% tariffs have now become 50%. To make matters worse, yeah. Can things get worse? Absolutely, they can. The US administration responded to perceived Chinese non-compliance by tightening export controls on high-tech products to China, including items needed for the C919 commercial airliner and advanced chip design software. Remember, C919, the commercial airliner, is a pet project of President Xi. So tighten the screws on that. Beijing tightens the screw on export minerals, export of rare earth minerals. And we now seem to be at an impasse that better be resolved for the sake of world trade, and for the sake of the stock markets, and for the sake of US consumer, and for the sake of Chinese consumer, the list goes so on and so forth. Now, the administration is also investigating China's trade practices for national security risks, which could lead to new tariffs on pharmaceuticals and other products, potentially offsetting the court ruling that was blocking most Trump-era tariffs. Remember, certain categories, certain countries, that's one way that the administration team is exploring, right? So pharma on China, specific category, specific sector, offsets the court ruling of the full extent of the reciprocal tariffs. Additionally, the US announced plans to revoke visas for Chinese students at American universities, which China condemned as discriminatory and politicized. Not a political show. As you all know what's going on with the Trump administration in Harvard. I'm going to let you guys, be the judge of that. Here to talk finance markets and the impact of all of that. Now, all these moves, along with high-level talks currently stalled, increase the risks that the truce between US and China may actually fall apart very soon, and sooner than expected. President Trump has said that he plans to talk to Chinese President Xi Jinping this week, but there's absolutely no clear sign as to when they would happen. Markets immediately gave back some of their gains on Friday, although I think JP Morgan CEO Jamie Dimon may have also spooked the markets by claiming that there is going to be a crack in the bond market. So that didn't help matters either. Now, the tariffs continued to be on the minds of the US consumer, as evidenced by the final May reading of the University of Michigan's Consumer Sentiment Index, which came in 52.2, one of the lowest ever recorded in data going as far back as 1952. On the plus side, if you can call it that, it was higher than the preliminary reading released 2 weeks ago, where the number stood at 50.8. Fluctuating tariff policies, especially announcements surrounding China and EU, made it very difficult for consumers and businesses to forecast prices. Over 2/3 of survey respondents spontaneously mentioned tariffs as a major concern, citing worries about inflation and economic instability. Consumers expect prices to rise 6.6% over the next year, up slightly from 6.5% in April, and the highest inflation expectation since 1981. However, silver lining. There's always some silver lining here and there. There's the 5-year inflation expectations edged down to 4.2% from 4.4%, ending a 4-month streak of increases. Speaking of inflation, consumers might have raised their inflation expectation, but the hard data points to a whole different picture. In a boost to the Fed, the central bank's preferred measure of inflation, the PCE, Personal Consumption Expenditure Price Index, showed only a slight increase in April 2025. Now, this moderation brought annual inflation rate closer to the Fed's 2% target, signaling further progress in taming the inflation beast that had surged in the early 2020s, 2022 to be precise. Remember the whole transitory part where an egg on the face for share Powell. Anyway, that was history. We moved on past that. And I think since then, the Fed has done a great job. More specifically, over the past 12 months, this index has increased, this index increased by 2.1%, down from 2.3% in March and approaching the central bank's 2% goal. The annual core inflation rate, which excludes the volatile food and energy prices, fell to 2.5% from 2.7% in March, indicating a continued cooling in underlying price pressures. And as further evidence that gloominess doesn't necessarily mean panicking, consumers might be gloomy about the economy. Consumers might blame the tariffs and all of that. However, that's not stopped them from spending. Consumer spending grew by 0.2% in April compared to March. So they continue to spend in April, while personal income actually rose by 0.8%. So gloominess doesn't necessarily mean panicking. I mean, you can be all negative, but you're still going to go out and buy things. Well, there you have it. That's exactly what's happening. These figures suggest that while inflation is moderating, both spending and income are still increasing, supporting the ongoing economic activity, thereby supporting the resilience of the US economy. All of this relatively optimistic data also came on Friday, the same day that President Trump expressed his anger in China, raised steel tariffs 25% to 50%, which perhaps explains why markets were not too negative. They were on Monday, though. Monday, US-China trade tensions were very, that was on investors' minds, and there was indeed a sell-off, a partial sell-off, not much of a sell-off, but a partial sell-off. I think Dow still ended in positive territory, but when the futures, the market futures were definitely negative, far worse than when the markets ended the trading session. Finally, I cannot wrap up this segment without talking about Nvidia. Right? I mean, I can't believe this. Normally, the moment Nvidia releases earnings, Doctor's Weekly Snapshot was Nvidia and nothing else. Everything else takes the backseat. Powell, then President Biden, all of you take the back seat. It's Gensanity, like one of my favorite CNBC Fast Money anchors, Tim Seymour puts it, Gensanity. So it used to be Gensanity, but now Gensanity has been kind of put on a pause by Trump mania. But that doesn't mean that it's not important. So I can't really forget. I mean, none of us should forget about Nvidia. I can't. It's my second biggest position in my portfolio. And I'm sure all of your portfolios, all of you own Nvidia at some point, at some levels, or are waiting to pounce in the company. Don't worry, I'll be doing a detailed Dr. Dissect segment of the company in the coming weeks. But for now, just giving you a bit of a snapshot, bit of a general picture about how Nvidia performed and what impact it had on the markets. Now, like I said, tariffs can take all the headlines, but that in no way, shape, or form implies that Nvidia has to take a backseat. On the contrary, a lot of the market's moves on Thursday were purely Nvidia driven. Remember, Nvidia reported Wednesday night after market close, Wednesday afternoon after market close, which shows how important the semiconductor giant continues to be for investors, and that's a good thing. Talking about results, and like I said, we'll be doing a detailed dissect segment in the coming weeks. Nvidia delivered record-breaking results for its first fiscal quarter of 2026, with revenue soaring to $44.1 billion, a 69% year-over-year increase, despite being blocked from selling its advanced AI chips to China, one of the world's largest semiconductor markets. It's a $50 billion opportunity, according to Nvidia CEO Jensen Huang. The company's robust performance was driven by surging global demand for AI infrastructure, especially from major cloud providers, and strong sales of its latest gaming chips. Now, Nvidia was unable to ship $2.5 billion worth of H20 AI processors to China in Q1 and expects to lose about $8 billion in revenue in the current quarter due to the ongoing US export controls. The company took a $4.5 billion charge for excess inventory and purchase obligations tied to the unsold H20 chips, which were far better, ladies and gentlemen, because the initial prediction was $5.5 billion charge. Now it's down to $4.5 billion. So essentially the $1 billion was because they found some reuse of materials. Not sure who bought it, but the CFO, Colette, Nvidia CEO Colette did say that it was it's a $1 billion, it's $1 billion better than what was initially expected. Now, the 50 billion China market is now effectively closed to Nvidia and other US chip makers, according to CEO Jensen Huang, who warned that this could have long-term implications for the industry and strengthen Chinese competitors. However, a combination of the overall AI infra boom, sovereign AI deals made recently during President Trump's visits to the Middle East, and the accelerated spending by the US hyperscalers, that's Amazon, Meta, Alphabet, Microsoft, was more than enough for the company to post a robust growth in its main data center business. Long story short, Nvidia's results underscored its dominant position in the global AI chip market and also offered enough evidence that the dominance was not going to go away anytime soon. Bottom line, what a week it was for the US market. What all did I cover? I covered tariffs, I covered inflation, I covered Nvidia, I covered the Fed, I covered EU, I covered China, I covered Nvidia and China, I covered Gensanity, Trump mania. What a week! All in a matter of 5 days, right? What a week it was for the US markets. And just so you know, it was Memorial Day on 26th as well. So it was a shortened trading week as it is. And what a week, though. Despite all of that, what a week it was for the US markets. Extremely action packed, but predominantly driven by tariffs. While the court ruling declaring the tariffs was as invalid as welcome news, as an investor, I wouldn't be too focused on that. Even if every appeals process fails, the plan B is strong enough that some form of tariffs will be imposed on nations by the Trump administrations, unless nations can make deals that which the US also finds favorable. The more concerning matter is the genuine threat of the US-China truce falling apart, which has the potential to cause widespread havoc to the global supply chains and take the US as well as all of us back to square one. It is vital that the talk between President Trump and President Xi happens soon, and more importantly, that those talks go well. I mean, anybody can have a talk, but and those talks could be bad. And if the talks are bad, doesn't really change the picture. In fact, it makes it worse. So it's very important that talks go well. I had to say it. Else, whatever progress we've been made so far until now would quickly unravel, and that is a no-brainer. And not even Godfather Jensen will be able to do anything with it, anything about it. On that note, let's head to the next segment. The doctor goes home. My, such an action-packed week. I think I need 2 rounds of sipping water. Now, in Doctor Goes Home segment, I'm going to take a break from all the economic data, from all the market data, because it's a new month. And a new month can mean only one thing. It means it's time to take a pause on all the market action and focus on the Indian auto sales numbers, right? We do this every start of every month. June's no different. We're going to talk about the May sales numbers. Now, it was largely a lackluster May for Indian automakers overall, with the overall sales for the month coming in largely flat. It's a 0.1% increase, but you can't call that growth, can you? It's essentially flat. I mean, approximately 352,000 passenger vehicles were sold last month, reflecting sluggish consumer demand in the local market. Now, having said that, the month of May and the sales in the month of May were a victim to the so-called high base effect. So even for sales to come in flat, when you really think about it, when you do a deep dive and think about it, it's actually pretty impressive. Demand was once again driven primarily by SUVs, surprise, and largely two-wheeler sales remained healthy. Obviously, we're going to get to the top car makers individually now, and you'll see this trend about how SUVs dominated the space and how two-wheeler sales were actually relatively healthy. Now, so without further ado, let's get to the top car makers individually now. India's largest car maker, Maruti Suzuki, saw a modest growth in its total sales, growing about 3.2% year over year, coming in at a little over 180,000 units. What a month the automaker had with respect to exports, which actually surged 80%. That is not a typo. I had to triple check it. 80%, 80 year over year to 31,219 units. While the mini and the compact segments continued to see declines, which has been the case in recent months, UV sales marginally rose, maintaining the growth trajectory. Investors should also note that domestic sales plunged 5.5% year over year, and the decline in domestic sales was attributed to softening demand, especially for entry-level cars, and reduced supplies to dealers amid India-Pakistan tensions and the operational adjustments. All in all, Maruti's sales growth was pretty much driven by exports. No doubt about that, as the likes of Fronx, Jimny, and Baleno saw massive demand internationally. Hyundai sales continue to decline with a 7.6% year-over-year drop experienced in May. Exports were positive for the company, thankfully, but domestic sales plunged down nearly 11% year-over-year. That's double the declines of Maruti. That's not a good sign at all. And as a Hyundai investor, I'm feeling the pain right now. Now, the company attributed the domestic sales decline to a scheduled week-long biannual maintenance shutdown at its Chennai manufacturing facility, which temporarily impacted the availability of key models such as Creta, Venue, and the Exter. In the domestic passenger vehicle market for May 2025, the good news was that Hyundai reclaimed the third position, narrowly surpassing Tata Motors after a 3-month stint in fourth place. However, there was absolutely no chance it could stop Mahindra & Mahindra, who cemented its second place with an outstanding month. M&M reported a significant 17% year-on-year increase in total vehicle sales for May 2025, reaching 84,110 units across all segments, including domestic and export makers. Domestic UV sales surged 21%, exports increased by 37%, bolstering the company's international business. In May 2025, M&M introduced the Mahindra Bold Edition for both Bolero and the Bolero Neo, further strengthening its product range. I'm speechless when it comes to, I mean, it's one of my biggest auto positions. I'm completely speechless to describe the company's growth. It's been phenomenal. It's been simply phenomenal. I think there is a lagging market sentiment in the stock, in my opinion. I think the stock has a lot more room to grow because the EV sales have not even been factored in fully. They've not really started to really affect the sales, sales growth, and it's coming. They've already launched the EV models. I'm just blown away by the growth demonstrated by M&M. Finally, we move on to Tata Motors. TAMO lost its third place, slipped to fourth place after having yet another disappointing segment for its PV segment. This is in the penalty box right now for me, as far as I'm concerned. When I say a stock is a penalty box, I am now contemplating, either cashing out completely, getting out of the market completely, or at least trimming to a very minor stake from my existing stakes. It's definitely in the penalty box, watching it every day, watching the technicals, watching the fundamentals. The fundamentals don't look good, clearly, but the technicals do matter for me. So I'm looking at it, and at some point, you'll hear me say, guys, I'm out of TAMO. I don't know. It looks that way for now. Total PV sales, including exports and EVs, declined by 11% year-on-year to a little over 42,000 units. Domestic PV sales were down 11%. The only saving grace were exports, which grew by 28%. Now, you compare that to 37% M&M, 80% Maruti Suzuki. Even exports are like, EV sales also saw a marginal 2% increase, and you're talking about the leader in EVs, right? The leader in EVs is that leadership is seriously under threat right now. It's kind of like Ola Electric, which was supposed to be leader, and that's definitely in the penalty box. In fact, don't be surprised if I tell you I've cashed out of Ola, even if it's at a minor loss. I've cashed out because I think that's a whole different Pandora's box there. Similarly, it's Bajaj and TVS have actually usurped Ola right now. Same goes for TAMO. I mean, you have a 2% marginal increase in EV sales. That's not particularly great. And it is facing stiffer competition from the rivals such as Mahindra, MG, which have posted stronger sales in recent months. And at the moment, I just don't see any catalyst that can stop this trend. I don't see any game changer can stop this trend. Right. Let's move on to two-wheelers now. And I did tell you at the start that they had an overall healthy month of May. Hero MotoCorp was back in the green, reported a 2% year-on-year in total sales for May 2025. The growth was primarily driven by higher domestic dispatches to dealers, reflecting steady demand in the Indian two-wheeler markets. Export sales also saw a marginal improvement, and the company highlighted that it continued to gain retail market share during the month, supported by positive customer response to its new products across both the motorcycle and the scooter categories. TVS Motor continued its stellar growth, registering a 16% year-over-year growth overall. Exports continued to surge for the company, registering a 22% year-over-year increase in May. Royal Enfield continued its upward trajectory, primarily driven by exports, which surged 82% year-over-year for May. Bajaj Auto was also back into positive growth trajectory, primarily driven by a surge in exports, as domestic sales only saw a modest increase. Bottom line, The Indian auto sector in May 2025 was characterized by robust export and EV growth, but domestic PV and CV demand remains subdued for some key players. The month from a passenger vehicle perspective clearly belonged to Mahindra and Mahindra, who has indeed become a growth machine that simply sees no stopping. With its EV model still not fully taken off, the growth potential still remains, and the likes of Hyundai and Tamo, who play in the UV space, have a lot of reason to worry. In the near term, there is a massive overhang for Indian automakers, and that's the continued restrictions from China on the export of rare earth magnets. We'll talk to you about that in the previous segment. A critical component that is used in both electric and gasoline vehicles. Some Indian car and auto component manufacturers had warned PM Narendra Modi's officials last week that the auto production could potentially halt within days if these export curbs continue. The industry's broader concern is that continued restrictions from China, which is a key supplier of rare earth magnets, could pose significant risks to manufacturing operations. As a result, Indian companies are urging the government to engage with Beijing to relax these export curbs to prevent further supply chain reductions and disruptions. This would be the main issue that auto investors like you and I need to worry about. With an above average monsoon season, which would revive rural demand, the demand is expected to significantly improve in the coming weeks and months. Whether supply can keep up with it should be the main question on investors' minds. All eyes will be on Beijing, who will have a major role to play in determining the trajectory of auto sales in the months ahead. With that, we're heading to the final segment, Dr. Dissects, where one of my favorite streaming names goes under the microscope and also one of my favorite stocks. It's got a very significant portion in my portfolio, a company that I call the king of streaming, company that probably most of you call the king of streaming. Sure, you would have guessed by now. And the company that I'm going to dissect this week, the stock that I'm going to dissect this week is Netflix, ticker NFLX. Okay, NFLX. Now, Netflix reported its Q1 earnings in the third week of April, so slightly a while back, and overall had a very strong start to the year. Both top and bottom line estimates handily beating analyst estimates. Q1 revenues were $10.5 billion. They were up 12.5% year over year, and they beat analyst estimates by $39.4 million. Diluted EPS came in at $6.61, and that was impressive, up 25.2% year over year, comfortably beating analyst estimates by 93 cents. Operating margins came in very strong once again, expanding by 360 bips, which is 3.6%, coming in at 31.7%. The company also generated free cash flows of $2.6 billion, a substantial jump from the $2.1 billion generated in the first quarter of last year. Guidance of the second quarter was also very strong, in my opinion. More specifically, the second quarter revenues are now expected to grow 15.4% year over year, and operating margins are expected to come in at 33.3%, which would be a substantial jump from the 27.2% that the company generated in the second quarter of last year. Finally, there were absolutely no tariff-related pressures facing the company as Netflix reaffirmed its FY25 guidance, which projects revenues to come in between $43.5 to $44.5 billion, operating margins to come in at 29%. It's not about the numbers, it's about the takeaway in the segments. If there is one takeaway for investors like you and I, and for prospective investors like most of you out there, from Netflix's Q1 report, is that the company has all the ingredients, in my opinion, to shield itself from any form of recession or economic slowdown. And I'm not basing this on Q1 report alone, but for what the company has planned for the quarters to come. First, the company's content slate is getting much stronger with each passing year. Q1 was absolutely no difference, as demonstrated by the widespread viewership of several of its titles. Examples include Adolescence, 124 million views; Back in Action, love the movie, starring Cameron Diaz and Jamie Foxx, 146 million views, became the company's sixth most popular English language film ever. And international releases such as Ad Vitam from France, 63 million views, and Counterattack from Mexico, 59 million views, both of which were placed in the top 10 of the company's all-time popular non-English language films. In addition to this, the company also tested new formats such as the toddler learning series Miss Rachel, which at 29 million views was consistent in the global top 10. Finally, there's the company's partnership with WWE. For WWE fans like you, if you're a fan like me, don't forget Money in the Bank Sunday, wherever you are. 7 p.m. Eastern. WWE hasn't paid me to do this. I'm just a fan. I continue, but the child in me is a massive fan. It's on Netflix, by the way. So the company's partnership with WWE, which has been a stellar success, is Monday Night Raw, ranked in the weekly top 10 list in 29 different nations, and has also maintained a spot in the global weekly top 10 list every week since its debut. I play a very, very major role in that. Now, looking forward, there is absolutely no evidence that indicates that this momentum is about to run out of steam anytime soon, recession or not. For instance, in India, from April 1st, which means it's already there, Netflix became the exclusive home for WWE with the option of a Hindi commentary as well. It's a significant step, in my opinion, one that I would expect would contribute to the company's growth in the APAC market, a region that has been seeing strong growth, revenue growth with each passing quarter. Revenue growth on a constant currency basis jumped from 14% year over year in Q1 of last year to 26% in Q1 of this year. Furthermore, second quarter would have more content that has the potential to be popular among viewers across the world. These include new movies such as Noone's Love the Movie, such as Vince Vaughn, a new series such as Straw, starring Tara G.P. Henson, and the Four Seasons, absolutely loved it, hilarious, starring Steve Carell and Tina Fey. Add to this the likes of the series finale of You and Big Mouth, and new season of Black Mirror and the Dallas Cowboy Cheerleaders, and you have a content slate that is absolutely unparalleled. It's nobody's up there. Nobody's fighting this. Finally, in Q3, the company plans to stream the Taylor versus Serrano boxing rematch after the first match became the most watched professional women's sport in US history. Q3 will also see the series finale of Squid Games, and at some point during this year, in fact, it's declared already, November, Stranger Things season finale. Christmas Day, Stranger Things season 5, volume 2, and New Year's Eve, the Stranger Things series finale. So the finale of Stranger Things is also waiting in Q4, which and they didn't even mention it in the Q1 letter to shareholders, but in Tudum, which is their live event, took place on June 1st. They finally released the data. Now, I know how many of you are like me have been anticipating this, and so much it's gotten to a frustrating point, right? But at least we know what happens with 11 and Vecna battling it out all out. What happens to Hawkins after all on November 26th for season 5, volume 1 of Stranger Things. On Christmas, you'll have season 5, volume 2 of Stranger Things, and New Year's Eve would be the series finale of Stranger Things. Again, Netflix has not told me to advertise this. It's just part of their content stream, which as investors, you should be really excited. Now, this steady stream of high quality content should shield Netflix from any macroeconomic headwinds such as a recession. Moreover, even if there is a recession in the US, Netflix would be entering such an environment for the first time with an ad-supported plan, which means that consumers would have a choice of opting for a lower price plan as they weather the recessionary storm. This would ensure that the churn is minimized. Overall, I simply don't see a scenario where Netflix loses out due to any form of macro headwinds, including one where nations impose levies on services. The company's content slate has been a stellar success, has attracted subscribers, and has also ensured an even higher retention rate, even as these consumers were cutting down on other discretionary items. Given that the quality of content slate isn't deteriorating in the coming quarters, there is absolutely no reason to believe the consumer would start canceling their subscriptions, even in the event of a recession. 2 days prior to the company's earnings release, there was a Wall Street Journal report that mentioned that Netflix aims to become a $1 trillion company by 2030 and also aims to double revenues to approximately $78 billion by 2030, including $9 billion in global ad sales by the same timeline. When investors look at the company's history of producing high-quality content, including iconic animation franchises, and when you factor in the company's growing gaming business as well as the steadily progressing ad business, these ambitious targets are very much achievable within the next 5 years. A recession, global or US-focused, ain't going to stop that. Book ready, pen ready, that can only mean one thing. Let's talk about valuation. As mentioned earlier, the company reaffirmed its FY25 earnings guidance, which means revenues are expected to come in between $43.5 and $44.5 billion. Now, the company has already exceeded its own Q1 revenue guidance, which increases the odds that the company would, at the very minimum, hit the high end of the full year guidance. As such, I'm not making any changes to my revenue projections from the last time I talked about. So FY25 revenue guidance for me, projected revenues are expected to come in at $44.5 billion. So $44.5 billion is the expected projected revenues. Now, based on management guidance, operating margins for FY25 are expected to come in at 29%. Now, the company's operating margins for Q1 exceeded its own expectations, coming in at 31.7. Q2 operating margins are now expected to come in at 33.3. I'm now tempted to raise my operating margins guidance as such, but management did highlight that the content-related expenses are projected to significantly grow and ramp in Q3 and Q4. The increase in spending makes sense given that some big ticket items are launching in these quarters, which include the likes of Taylor Serrano, the Christmas Day NFL games, as well as a heavier film slate in Q4. All things considered, I'm maintaining my operating margins at 29%, which means operating income projected would be 12.9 billion. So operating margins at 29%, and that means that operating income projected is 12.9 billion. Now, I assumed FY25 non-operating expenses to be 662. So non-op expense is 662 million, which would be approximately the average net non-op expenses in the last 5 years. Non-operating expenses for FY24 were 452. If one looks at Q1 non-operating expenses, there were 18. Q1 non-operating expenses for FY25 would already amounted to 133 million, which implies that overall non-operating expenses would be significantly higher than 452 million. So 662 makes sense in my opinion. Now, I maintain the same projected tax rate at 12.6%. Taken this together, FY25 net income after tax, FY25 net income after tax would be 10.7 billion. Okay, 10.7 billion is FY25 net income. Now, according to the company's latest income statement on account of repurchases, the weighted average of common stock used to calculate the diluted EPS has come down to 436.9 million from 437.8 million. If you use the 436 million, diluted EPS FY25 projected would come in at 24.49, marginally higher than my previous estimate of 24.44, and it would represent an EPS of 23.5%. Now, given a cocktail of tailwinds that the company has, despite the macro uncertainties in the form of a strong content slate, steadily growing advertising business, more room to capture in the market, I'm of the opinion the company should continue to grow its bottom line at double digits in FY26 as well. I have therefore assumed FY26 EPS growth to be the same as FY25, which is 23.5%, slightly lower than its mean long-term EPS growth of 25.3%. Now, according to Seeking Alpha, Netflix's forward PEG ratio, price to earnings to growth ratio, currently stands at 2.12, well above its 5-year average of 1.49. Now, I've presented under these two scenarios, 2.12 and 5.49, the two scenarios, the new price target, if you take the average price target, would actually be 1,283, well above my previous price target of 946, which suggests an upside of about 6.3% from current level. Now, while Netflix's stock has very, very strong momentum, highest I've seen in some of the top stocks, it has got an A+ grade on Seeking Alpha's momentum grade. There's nothing higher than that. The upside is, given the fact that the upside is limited, I'm going to maintain the rating as a whole. So despite very strong momentum, I'm not going to recommend this as a buy, but because the limited upside is it's about 6.3, but it has very strong momentum. So, but I'm still going to maintain an hold rating with a price target of 1,283. So, but like having said that, given the strong momentum, if there is any pullback, this is it. This is the stock you want to own. There's nothing challenging it at the moment, right? I mean, so I'm putting it hold simply because fundamentally I don't see more upside from these levels. But that shouldn't stop that if there is any meaningful pullback in the name, go, go, go is what would be my signal to you guys. Obviously, you do your own research. This is not investment advice, just my opinion. Now, bottom line, it was yet another stellar quarter from Netflix, beating on both the top and bottom lines. The company once again demonstrated its ability to manage its expenses, as evidenced by the strong op margins and free cash flows. The company also released a content slate that generated strong viewership engagement. More positive progress was seen in the ads business, and its partnership with the WWE has also shown early signs of success. With a stronger content slate set to be released in the coming quarters, including series finales of some of its fan favorites, Stranger Things, Squid Game, all of that, the company planning to roll out its ad tech platforms to some more markets outside the US soon, Netflix approaches a challenging macro environment from a position of strength. Moreover, given that it has lower priced ad supported plans, the odds of cancellations are much lower during these turbulent periods compared to previous downturns. From a valuation perspective, Netflix indeed has the strongest momentum among that any stock can, but limited upside. As such, I've maintained my rating on the stock as a hold, and have not upgraded to rather than upgrading it to a buy. Might be a recession, might not be a recession. Netflix to me has proven that it is an all-weather company. Naturally, the stock has also become one to own for all occasions. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I'll see you next week for episode 131. Until then, stay safe and make some money.